This Fed move could cost you $4,200 a year. The S&P 500 has been a staple of long-term investing, but its performance can be heavily influenced by economic conditions and Fed decisions. We'll examine what happens when you invest in the S&P 500 during tumultuous times, like the dot-com bubble, and how it affects your wallet. What if you'd invested $10,000 at the peak of the dot-com bubble? If you'd invested $10,000 in the S&P 500 at the absolute top of the dot-com bubble, here's what you'd have today. Around $17,000, considering the index's performance over the past 20 years. But that's not the whole story. The S&P 500 did plummet by over 40% in the year 2000, and it took until 2007 for the index to recover. So, if you'd invested $10,000 in March 2000, you would have seen your investment drop to around $6,000 by October 2002. And if you'd invested $10,000 in the S&P 500 in 2007, just before the financial crisis, you would have seen your investment drop to around $5,500 by March 2009. But, as we know, the market recovered, and if you'd held on, your $10,000 investment would be worth around $34,000 today. For example, consider the case of Peter Lynch, who invested $10,000 in Fidelity's Magellan Fund in 1977. By the time he retired in 1990, his investment was worth over $250,000. Similarly, if you'd invested $10,000 in Johnson & Johnson in 1980, your investment would be worth around $1.3 million today. But the part that surprised me most is what this does to your long-term returns. That is next. The recent Fed move could cost you $4,200 a year. But what if you'd invested $10,000 in the S&P 500 at the peak of the dot-com bubble? The Fed's decision to raise interest rates can have a significant impact on the stock market, and the S&P 500 is no exception. In fact, since 2000, the S&P 500 has experienced an average decline of around 10% in the 6 months following a Fed rate hike. But it's not all doom and gloom. The S&P 500 has also experienced an average gain of around 15% in the 12 months following a Fed rate hike. So, what does this mean for your investment? If you'd invested $10,000 in the S&P 500 in 2000, and the Fed had raised interest rates by 1% in 2001, your investment would have been worth around $8,500 by the end of 2001. But if you'd held on, your investment would be worth around $24,000 today. For instance, back in 2008, during the financial crisis, the Fed's decision to lower interest rates helped stimulate economic growth, and the S&P 500 eventually recovered. However, a common misconception is that the Fed's actions directly cause market fluctuations, when in fact, it's often a combination of factors, including economic conditions and investor sentiment. The impact of Fed moves on your portfolio is not the only thing to consider. The impact of inflation is also critical. That is next. But the part that surprised me most is what this does to your 401k. Will you be able to retire on time, or will the recent Fed move impact your retirement savings? We'll explore how the Fed's decision affects your long-term investments and what you can do to protect your portfolio. For example, if you'd invested $10,000 in a diversified portfolio in 2000, you might be surprised to learn that it could be worth over $50,000 today, despite the market fluctuations. Stay tuned to find out how to safeguard your financial future and learn the specific steps you can take to mitigate the impact of Fed moves on your investments. The impact of inflation on your investment is significant. If you'd invested $10,000 in the S&P 500 in 2000 and inflation had averaged 2% per year, your investment would be worth around $20,000 today in nominal terms. But in real terms, your investment would be worth around $14,000, considering the impact of inflation. So, what does this mean for your investment strategy? If you're investing for the long term, it's essential to consider the impact of inflation on your returns. One way to do this is to invest in assets that historically perform well in periods of high inflation, such as precious metals or real estate. For example, if you'd invested $10,000 in gold in 2000, your investment would be worth around $30,000 today. Back in 2008, during the financial crisis, many investors turned to gold as a safe haven asset, and it's not hard to see why. Additionally, A second-order effect of inflation is that it can also impact the purchasing power of your retirement savings, making it even more critical to consider inflation when planning for your financial future. The impact of inflation is not the only thing to consider. The impact of economic conditions is also critical. That is next. But the part that surprised me most is what this does to your investment strategy. Will you need to rebalance your portfolio, or are there other steps you can take to mitigate the impact of inflation and economic conditions? We'll explore the importance of diversification and how it can help you navigate uncertain markets. For instance, if you'd invested $10,000 in a mix of stocks, bonds, and real estate in 2000, you might be surprised to learn that it could be worth over $60,000 today, despite the market fluctuations. Get ready to learn how to protect your investments and achieve your long-term financial goals, and discover the specific asset allocation that could help you thrive in any market condition. The importance of diversification in your investment portfolio cannot be overstated. If you'd invested $10,000 in the S&P 500 in 2000, and you'd also invested $10,000 in a diversified portfolio of stocks, bonds, and real estate, your investment would be worth around $50,000 today. But if you'd invested $10,000 in the S&P 500 in 2000, and you'd also invested $10,000 in a portfolio of just stocks, your investment would be worth around $30,000 today. So, what does this mean for your investment strategy? If you're investing for the long term, it's essential to consider the importance of diversification in your portfolio. One way to do this is to invest in a mix of assets that historically perform well in different economic conditions, such as stocks, bonds, and real estate. For instance, during the 2008 financial crisis, many investors who had diversified portfolios were able to weather the storm better than those who had invested solely in stocks. A common misconception is that diversification means sacrificing returns, but that's not necessarily true. By spreading your investments across different asset classes, you can actually reduce your risk and increase your potential for long-term growth. For example, if you'd invested $10,000 in a diversified portfolio in 1980, you might be surprised to learn that it could be worth over $100,000 today, despite the market fluctuations. In conclusion, if you'd invested $10,000 in the S&P 500 at the peak of the dot-com bubble, you would have seen significant fluctuations in your investment over the past 20 years. However, if you'd held on, your investment would be worth around $34,000 today. The key takeaway is that long-term investing requires patience, discipline, and a well-diversified portfolio. To put this into action, take a closer look at your current investment strategy and consider rebalancing your portfolio to ensure you're adequately diversified. Specifically, you may want to consider allocating 60% of your portfolio to stocks, 30% to bonds, and 10% to real estate, and then adjusting as needed based on your individual financial goals and risk tolerance. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about investing, hit subscribe. I break down one of these every week, and I'll also provide you with a free resource to help you get started on your investment journey.